Have you ever wondered where the Indian stock market might be in the next 10 years? It's an intriguing question that invites us on a journey of exploration and discovery. Today, we're embarking on a comprehensive exploration of the Indian stock market, a dynamic entity that reflects the pulse of the nation's economy. We'll take a deep dive into snapshots of various sectors, understand the fundamentals of stocks, and discern the distinction between trading and investing. We'll also delve into the different types of stocks: blue chip, large cap, mid cap, small cap, and penny stocks, each with their unique characteristics and potential. We'll then guide you on how to identify future sectors that might dominate the Indian stock market in the next decade, considering emerging trends, technological advancements, and socioeconomic shifts. So fasten your seatbelts as we navigate the exciting terrain of opportunities that the Indian stock market holds. Stay tuned to explore the exciting opportunities that the Indian stock market holds. To understand the future, we must first understand the present. Let's embark on a journey across the sectors of the Indian Stock Exchange, examining the key factors that contribute to their performance and the indicators that could signal their future success. First up, we have the banking sector, the backbone of our economy. Its performance is often a reflection of the country's economic health. Look out for indicators such as interest rates, non-performing assets or NPAs, and government policies. Next, we have the FMCG or fast-moving consumer goods sector. This sector is considered a reliable performer, showing resilience even during economic downturns. Key indicators to watch include rural and urban consumption trends, inflation, and disposable income. Then there's the IT or information technology sector. It's a sector that has seen exponential growth in the last few decades, fueled by globalization and digital transformation. Keep an eye on global IT spending, exchange rates, and technological advancements as indicators of its future performance. Let's not forget the pharmaceutical sector, often seen as a defensive play in volatile markets. Its performance can hinge on research and development, patents, and global health crises. The auto sector, too, has its role to play. It's a sector that's closely tied to the country's economic cycles. Look out for factors like auto sales, interest rates, and raw material prices. The construction and infrastructure sector is another key player. It's directly influenced by government policies, urbanization trends, and interest rates. The telecom sector is another interesting one to watch. With the advent of 5G and digital transformation, it's a sector that's poised for significant growth. Key indicators here include subscriber growth, data usage trends, and regulatory policies. Lastly, we have the energy sector, a sector that's deeply intertwined with global political and economic dynamics. Keep an eye on global oil prices, renewable energy trends, and government policies. Now, these sectors don't operate in isolation. They're part of a complex interconnected web that forms the Indian Stock Exchange. And each sector's performance can have ripple effects across the entire market. So, as investors, it's crucial to keep a pulse on these sectors, understanding the factors that drive them and the indicators that could signal their future performance. Remember, investing is not just about picking stocks, it's about understanding the larger economic picture, the sectors that make up the market, and the factors that drive their performance. It's about making informed decisions based on a deep understanding of the market dynamics. Now that we have a snapshot of where each sector stands, let's delve deeper into the fundamentals of stocks. Every investor must know the ABCs of stocks. And by ABCs, we're talking about the fundamentals that help you evaluate a stock's potential. Let's break down these terms in a way that's easy to grasp. The first term you should know is the 200-day moving average. This is the average of a stock's closing price over the last 200 days. It's a key indicator used to identify the stock's overall trend. If the stock price is above this average, it's generally considered to be in an uptrend, while if it's below, it's in a downtrend. Now, let's talk about open-close price. The open is the price at which a stock starts trading when the market opens. The close, on the other hand, is the last price at which it trades before the market closes for the day. These prices can provide insights into the day's trading activity. The upper circuit UC and lower circuit LC limits are the maximum and minimum price at which a stock can be traded on a given day. These limits are set to prevent excessive volatility in the stock price. Market cap or market capitalization is the total value of a company's publicly traded shares. It's calculated by multiplying the stock's current market price by the total number of outstanding shares. It's a key indicator of a company's size and market value. EPS, or earnings per share, is a measure of a company's profitability. It's calculated by dividing the company's net income by the number of outstanding shares. A higher EPS indicates a more profitable company. Price-to-earnings ratio, or PE, is a valuation ratio that compares a company's current share price to its per-share earnings. A high PE ratio could mean that a stock's price is high relative to earnings and possibly overvalued, while a low PE ratio might indicate that the stock is undervalued. Then we have the book value per share, which is the value of a company if it were to be liquidated today. It's calculated by dividing the company's total tangible assets minus its total liabilities by the number of outstanding shares. The face value of a stock is the nominal value of a share as determined by the company. It's the original cost of the stock, shown on the certificate. The percent dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. The higher the dividend yield, the more an investor earns for every dollar invested in the company's stock. Finally, corporate actions such as board meetings, AGMs, EGMs, bonus issues, stock splits, dividends, quarterly results, etc., are important events that have a direct impact on a company's stock price. Keeping an eye on these can provide valuable insights into a company's financial health and future prospects. Now that we understand the basics, let's compare the two major indices of the Indian stock market: Sensex and Nifty. Sensex or Nifty, what's your pick? You've probably heard these names in the context of the Indian stock market, but what's the difference between them? The Sensex, or the Sensitive Index, is the benchmark index of the Bombay Stock Exchange. It's a free-float, market-weighted index that represents the performance of 30 financially sound and well-established companies across key sectors in the Indian economy. On the other hand, the Nifty, or the National 50, is the flagship index of the National Stock Exchange. It represents a more diverse portfolio of 50 companies across 12 sectors, offering a broader view of the market. While both indices serve as barometers of the Indian stock market, they differ in their composition and representation. The Sensex, with its 30 blue-chip stocks, is often viewed as a gauge of the country's large-cap companies. The Nifty, with its wider sectoral coverage, is seen as a more comprehensive indicator of the market's pulse. But why should investors track both? Well, by keeping an eye on both the Sensex and the Nifty, investors can gain a more nuanced understanding of market trends. They can compare the performance of different sectors, identify patterns, and make informed decisions. For instance, let's say the Sensex is trending up while the Nifty is moving sideways. This could indicate that large-cap stocks are performing well, while mid- and small-cap stocks are lagging. Such insights can be valuable when planning investment strategies. Moreover, these indices are not just indicators of market performance. They also serve as benchmarks for mutual funds, exchange-traded funds, and index funds. They guide fund managers and analysts in assessing the market and making investment decisions. So, whether you're a seasoned investor or just starting your journey, understanding the role and significance of the Sensex and Nifty can be incredibly beneficial. It can help you navigate the market, make informed decisions, and ultimately grow your wealth. With a clear understanding of these indices, let's now explore the fundamental difference between trading and investing. Trading or investing, what's your game? Let's explore these two strategies. Trading and investing, while both involve participating in the markets, are two different approaches, each with its own set of goals, tactics, and risk profiles. To begin with, trading is a method of holding stocks for a short period of time. It could be for a week, a day, or even a few minutes. The traders, driven by the changes in the stock market, aim to profit from short-term price fluctuations. They rely on technical analysis, charts, patterns, and the momentum of the market to make their decisions. On the other hand, investing is a strategy that focuses on gradual wealth accumulation over an extended period of time. This could span years or even decades. Investors buy and hold assets such as stocks, bonds, or mutual funds with the expectation that these assets will generate income or appreciate over time. They base their decisions on fundamental analysis, studying the company's financial health, its business model, industry position, and economic factors. Now let's talk about risk and returns. Trading can be likened to a sprint. It's fast-paced, intense, and requires constant attention. The potential for quick profits is high, but so is the risk of substantial losses. Investing, on the other hand, is more of a marathon. It's a slow and steady process, and while the risk of loss still exists, it is often reduced by the extended time horizon. In terms of capital growth, traders seek profits from market price fluctuations, while investors gain from dividends, interest, and capital appreciation over time. This difference in strategies also affects the way profits are taxed. Generally, profits from trading are subject to short-term capital gains tax, which can be higher, while profits from investing are subject to long-term capital gains tax, which is typically lower. So whether you're a trader or an investor depends on your financial goals, risk appetite, time commitment, and market knowledge. But remember, both strategies require discipline, patience, and an understanding of the markets. Now that we have differentiated between trading and investing, let's delve into the types of stocks available for investment. Scene script: blue chip, mid-cap, small-cap, or penny stocks. Where should you put your money? We've all asked ourselves this question at one point or another. The answer, as you might expect, isn't one size fits all. It depends on your financial goals, risk tolerance, and investment strategy. Let's start with blue chip stocks. These are shares in large, well-established companies with a history of reliable performance. Think of companies like Reliance Industries, Infosys, or Tata Consultancy Services. They're like the tortoises in the investment world, slow and steady, often paying regular dividends. They're a great fit for conservative investors who prioritize stability over high growth. Next, we have mid-cap stocks. These are companies that fall somewhere in the middle of the market capitalization spectrum. They're not as large as blue-chip companies, but they're not small either. Companies like Apollo Tires or Mindtree fall into this category. These stocks offer a balance between growth potential and risk, making them a suitable choice for investors looking for moderate growth and are willing to tolerate some level of volatility. Now let's talk about small-cap stocks. These are shares in smaller companies that have significant growth potential. But with great potential comes great risk. They're more volatile than their larger counterparts and can be influenced by market conditions to a larger extent. Companies like Vmart or Just Dial would fall into this category. These stocks are for investors who are willing to accept higher risk for the potential of higher returns. Lastly, there's the world of penny stocks. These are stocks that trade at very low prices, often less than a single rupee. They're highly speculative and can provide substantial returns, but they also come with considerable risk. Companies like Birla Pacific Medspa or Sujana Universal Industries are examples of penny stocks. These stocks are typically for investors with a high-risk, high-reward mentality. It's important to note that diversification is key in investing. By spreading investments across different types of stocks, you can balance risk and reward. A portfolio might include a mix of blue chip, mid-cap, small-cap, and even some penny stocks, depending on an investor's goals and risk tolerance. Remember, investing isn't a gamble. It's about making informed decisions based on careful research and analysis. When choosing stocks, it's essential to look at the company's financials, management, industry position, and market trends. And of course, always consider your own financial goals and risk tolerance. With a better understanding of the types of stocks, it's time to look into the future. After all, the stock market isn't just about where companies stand today, but where they could be tomorrow. What sectors should you keep an eye on for the next 10 years? Let's dive into the future of the Indian stock market, shaped by emerging trends, technological advancements, and socio-economic shifts. Firstly, we have the renewable energy sector. The world is pivoting towards cleaner energy sources, and India is no exception. We're talking solar and wind energy, energy storage, and green infrastructure development. A company to watch in this sector is Adani Green Energy, already making waves in the solar power space. Next up is the technology and artificial intelligence sector. The integration of AI-driven solutions across industries is a worldwide trend, and Indian companies are well-positioned to ride this wave. Infosys, a leading name in tech consultancy, is one such stock to keep an eye on. Thirdly, the electric vehicles and sustainable transportation sector is poised for massive growth. As India embraces electric mobility, companies like Tata Motors, with its increasing focus on EVs, are set to benefit from this transition. Healthcare and biotechnology is another sector to monitor closely. The pandemic has accelerated the adoption of telemedicine, healthcare technology, and personalized medicine. Dr. Reddy's Laboratories, a pioneer in the Indian pharmaceutical industry, could be a great pick in this sector. let's not forget about digital services, online retail, and e-commerce. With the increasing digitization of India's economy, companies like Reliance Industries, with its digital services arm Jio and its online grocery store JioMart, could reap significant benefits. Infrastructure is another crucial sector. As India continues to urbanize, construction, smart cities, and related projects will likely see an uptick. Larsen & Toubro, a major player in the Indian infrastructure space, could be a promising stock in this sector. Agritech is an emerging sector that holds great promise. Companies involved in precision farming, agritech solutions, and sustainable food processing are seeing growing interest. UPL Limited, a global leader in agri-inputs, is a stock that could benefit from this trend. Lastly, let's talk about telecommunications. The advent of 5G technology is expected to revolutionize communication, and companies involved in telecommunications, network infrastructure, and digital connectivity may experience growth. Bharti Airtel, a leader in the Indian telecom industry, is a stock to watch in this sector. While these sectors look promising, it's crucial for investors to carefully analyze them, considering factors like government policies, market trends, and global influences. Remember, investing is not about jumping on the latest trend, but about understanding the underlying fundamentals and growth potential of a sector or a company. In conclusion, the future of the Indian stock market appears promising, driven by economic growth, technological advancements, and evolving consumer trends. However, as investors, we need to navigate challenges, stay informed, and adopt a well-balanced approach. It's about capitalizing on the market's potential while effectively managing risks. And who knows, maybe the next multi-bagger is already in your portfolio, waiting to be discovered. After all, stocks like ITC, Dabur, Titan, and Infosys did not become wealth creators overnight. They were the result of informed decisions, patience, and the power of compounding. So, keep an eye on these sectors, stay informed, and happy investing. We've covered a lot of ground today. Let's quickly recap. We began by exploring the vibrant and diverse sectors of the Indian Stock Exchange, each with its unique dynamics and growth drivers. We delved into the intricacies of understanding the performance of these sectors, using key indicators to evaluate their future potential. Next, we ventured into the realm of stock fundamentals, unraveling the importance of metrics like the 200-day moving average, open and close price, and market cap, among others. These elements form the bedrock of astute investment decisions, allowing us to assess a company's financial health and potential for growth. We then compared the two major Indian indices, Sensex and Nifty, highlighting their significance as comprehensive indicators of market performance. These benchmarks serve as crucial tools for us, the investors, fund managers, and analysts, to gauge overall market trends. In the battle between trading and investing, we underlined the fundamental differences and the role each plays in our financial journey. Whether it's the quick-paced world of trading or the long-term horizon of investing, the choice depends on our individual goals and risk tolerance. We also examined the spectrum of stocks, from the stability of blue-chip and large-cap stocks to the potential high-reward scenario of penny stocks. The key takeaway here is the importance of thorough research and understanding our risk tolerance when choosing stocks from these different categories. Finally, we identified promising sectors in the Indian stock market for the next 10 years, considering emerging trends, technological advancements, and socioeconomic shifts. Sectors like renewable energy, technology and AI, electric vehicles, healthcare and biotech, digital services, infrastructure, agritech, and telecommunications hold immense potential. Remember, the Indian stock market holds immense potential, but it's up to us as investors to navigate the waters wisely and capitalize on these opportunities. The future is bright, and with careful analysis, a balanced approach, and a keen eye on emerging trends, we can harness the growth potential of the Indian stock market.